As we look at earnings season, we can kind of start to draw some conclusions about what we have learned. Liz Ann Sonders is going to help us do that as well. Chief Investment Strategist at the Schwab Center for Financial Research. Liz Ann, it's good to talk to you good to talk to you as always. Wow. I guess it is the end of earnings season because I can't speak anymore. So, Liz Ann, as we look back here, there's been all of this talk about whether we're at peak earnings. We're having that discussion regarding Walmart, kind of where does it go from here? How are you thinking about earnings in that way in terms of, I know you can't talk to us about Walmart specifically, but in terms of sectors where we might have peaked and where there's more room to go?
Yeah, so I think it's almost unquestionable for second quarter to be the peak, not growth, but growth rate. So earnings will continue to grow. I think the consensus for the third quarter is close to 30%, but I don't think we're going to beat the nearly 100% gain in the second quarter. But there are vast sector differences. Energy has been a big swing factor for obvious reasons, given the fluctuation in oil prices. I think what's really key looking ahead is the profit margin story, which so far they've been maintained at a pretty high level, but given the ongoing wide spread between input prices and final goods prices, I think the profit margin story becomes maybe even more important than the headline earnings story next quarter.
Liz Ann, you're just staying on Home Depot and a Walmart, and these companies that we're seeing slowing growth from them, and to me, that is indicative of a maturing economic cycle. And to that end, where do you go? Where should you invest? What companies are good investments when you're in fact seeing peak growth?
So I think that the focus should be more on sort of factors or characteristics than either sectors or styles. I think especially in this world of still popular passive investing, often people either gear themselves toward a particular sector or style indexes, large growth, large value, small value. But the factors, I should say, that have been outperforming all year, and I think will continue, are tied to quality within growthier sectors, within more value-oriented sectors. So strong balance sheet, strong actual earnings growth, strong free cash flow yield to pull sort of a quality value factor in there. We only have one outperform rating right now on sectors, which is healthcare, because we think it offers that hybrid of decent value, still growth characteristics. But if you're a stock picker, I would focus more on those factors around quality and not limit yourself at the sector level or at the style level.
Liz Ann, we've talked to a number of folks this summer who have talked about the idea of the market going through a rolling correction of sorts. And you talked about these factors, styles, what have you. We've seen 10% corrections in some pockets of the market, even deeper than that. But the overall index has remained elevated. How do you explain really what's been holding the index level at a record, basically, when there's plenty of discomfort under the surface?
There is, and I think maybe because a lot of the real speculative excess, the speculative froth that we saw earlier this year was concentrated in areas outside the traditional indexes and the leadership names. So it's clearly been in the meme stocks and crypto and SPACs and non-profitable tech, some of those thematic areas where during the worst phase of their drawdowns, you're talking 30, 40, 50%, even more in some cases. So I think those, as I've been calling them, micro bubbles, have gotten pricked, and you've seen a significant drawdown because that's where the speculative froth was most concentrated, less so in the major indexes. Right now, though, the problem is that S&P still trading near an all-time high, decent breadth, but much weaker breadth statistics under the surface for indexes like the NASDAQ and Russell 2000. And that's a budding concern because of that non-confirmation.
And Liz Ann, I also want to ask you about an interesting chart you brought us, which talks about a different kind of excess, I guess, a real one, which is supply shortages. And you talk about what business leaders, company leaders have been saying about supply shortages, saying the mentions of supply shortages peaked in May, which lends credence to the whole idea that inflation is going to moderate. But what other conclusions are you drawing from that?
Well, and you've also seen it in things like ISM manufacturing supplier deliveries, which finally started to come down. The rub more recently, though, is with the surging Delta variant and the greater willingness and speed with which a place like China shuts things down with port closures, we could start to see that supply problem kick back in earnest, which clearly has been a factor in the spike in many of the inflation statistics we've seen. So Delta also acts as a depressant on the demand side of the economy, but I think the impact on the supply side is probably a more significant component, meaning the weaker demand is not going to be an offset to the supply disruption. So that part of the inflation story is looking maybe a bit less transitory because of the impact of Delta.
And just quickly, Liz Ann, then what kind are you going to be looking at that indicator? Are you going to be looking at ISM as we go forward? What are going to be your keys to trying to figure that out?
Well, short term, I think we're past the base effects. So the supply chain disruptions, I think, continue to be the big factor, both short and medium term. And then wage growth. I think key to the longer term inflation story is how sticky some of these wage increases we are seeing, whether it becomes not just a one-time reset, but an ongoing issue. Then that potentially feeds into more of a wage price spiral. We don't think those conditions are in place yet, but that's what I'd keep an eye on over the next several months.
All right, we will too. Liz Ann, thanks so much. Liz Ann Sonders is Chief Investment Strategist at the Schwab Center for Financial Research. Appreciate it.
Yesterday, we had a big deal in the travel space. Hyatt announcing a deal to acquire Apple Leisure Group for some $2.7 billion, bringing Hyatt into the luxury travel space as well as bringing it into the all-inclusive resort space. Joining us now to discuss the deal and the reshaping of the Hyatt portfolio, President and CEO at Hyatt, Mark Hoplamazian. Mark, thanks so much for jumping on this morning. Let's just start with kind of how you guys thought about this deal in the context of, one, a Hyatt that continues to change, its portfolio structures you guys discussed on the call yesterday, but also with travel recovering, particularly leisure travel, and looking out, to what the future of travel might be post-pandemic.
Thanks, Myles. Good to be here. Thanks for having me. First, I would say that leisure travel has been the most resilient and durable segment of the travel industry for a long time. It's not just a COVID and post-COVID phenomenon where we've seen tremendous recovery in leisure travel. It's also been the case after downturns in the past. The power of human connectivity and human connection, where people want to reunite with family and friends and loved ones and actually take a break, has never been more important for obvious reasons. And so this is really something that we think is going to continue to be a segment with tremendous growth within the leisure segment. Resorts in particular and all-inclusive resorts are a very fast-growing segment in both the Americas and in Europe. We're going to be doubling our global resort presence upon closing this deal. We're adding over 100 resorts, and we're growing our footprint in Europe by 60%. So it's a really transformative deal in terms of the markets that we can cover.
Mark, it's Julie here. You guys have been transitioning to a more asset-light model. So how does then this deal kind of fit into that?
Yeah, it's actually, it really unlocks the next chapter of accelerated transformation to being an asset-light company. We started off life as a public company almost 12 years ago, and we were at a 2/3, 1/3 split of earnings. 2/3 of our earnings came from owned and leased hotels, and 1/3 came from our fee business. By the time we close the deal and finish an additional $2 billion sell down of assets that we announced yesterday, we will be at a 20-80 split, 20% from owned and leased and 80% from fees, and that's by 2024. So it really is quite a significant unlock. And aside from reducing the earnings from owned and leased hotels, this is really an asset-light business that we're buying. So it's all fee-based income. So it really is transformative from a mix of earnings perspective.
And then, Mark, I venture you don't make an acquisition of this size if you don't have some form of visibility into your business over the next 12 to 18 months, what are you seeing for 2022 booking trends?
Well, what I would tell you is that the best visibility that we have is in group business. That's the longest lead time booking curve, and the 2022 progression was tracking at about 15% below 2019 levels, and we have an expectation, that we'll see more bookings come through on the group side. So we see that happening, and that group business is not strictly corporate and association. There are leisure groups, there are sports groups, and other specialty groups. That's the best visibility we have into bookings for next year. But I'll tell you that the momentum that we've seen through July has been remarkable in leisure. The luxury leisure segment in particular is particularly durable because a lot of our core customer base have the means to be able to travel, and it is the first thing that they've turned to. So I would say that we do expect leisure and business to be vibrant into next year. For the next few months, a little harder to say because, of course, people are still contending with the variability of the Delta variant and coping with that. But we see this really as a trend, longer term trend, and something that we're looking forward to for the next 5 to 10 years.
Have you seen any cancellations of late because of that you can tie to the COVID variant?
The most acute downturn that we've seen due to Delta is in China. The playbook that the Chinese government has used when they've had outbreaks of this type is to be very aggressive about limiting travel and limiting activity, actually. So there are very, very strict restrictions on movements. And in China, we've seen a very precipitous drop in bookings. Our experience and history with that is that subsequent to those extensive restrictions, demand recovers quickly because you end up with sort of a compressed pent-up demand that springs into the future. And then in terms of bookings into August, so sort of more real time, we have seen some declines. And I think part of that was in the Caribbean, at least due to the tropical storm that was threatening to be a hurricane. Fred, I think is they named it. And then apart from that, I surmise that there are some Delta variant impacts at this point. Again, we do expect, especially given our training from the last 18 months, that this is not a smooth road, and we're going to be managing through and having to continually adapt and pivot.
Like all of us, for sure, Mark. Finally, I want to circle back to the deal and ask you one more question about that, which is that you guys are taking on $1 billion in debt to buy Apple Leisure. S&P said that you might be subject to a debt downgrade as a result. What effect would that have if your bonds were downgraded to junk in terms of your borrowing ability going forward?
Well, S&P is one of the rating agencies that rates Hyatt. We have 2 other ratings, and I think the other rating agencies have been more optimistic and supportive, I guess. I think the thing that I would say is that we got $2 billion of assets that we've committed to sell. The market for hotel assets, especially of the quality that we have, has been very robust. So we have many alternatives as to how we can ultimately raise capital and pay down debt over time. We have cherished our investment grade profile since the time, actually well before the time we were public, and as a company. And so my view is that we've always run a conservative balance sheet, and while we are taking on additional debt, in the short term, we expect to be able to pay it down and then some over the next 3 years as we sell down assets.
And then, Mark, just finally on the asset sales, I'm just curious who's coming to you guys and wants to buy it. We hear so much about dry powder out there. Are these what's the buyer profile, I guess, of the folks that you're talking to? And again, as you guys mentioned, $2 billion more of asset sales expected by 2024.
Yeah. So first of all, REITs are active, public REITs, and private REITs are active. There are several large private REITs that focus on hotel acquisitions, and then both private equity, private investment groups, as well as foreign sovereign funds that support principles in the marketplace. So it really is from a variety of different sources, which is another reason why we're confident that we're going to be able to execute really well. We're completing, since 2017, when we announced that we would start selling down assets, by the end of this year, we expect to have sold over $3 billion of assets at a 17.4 times EBITDA multiple, which is well above what we predicted. So we have a track record, and this is an incremental $2 billion, and we think we're very confident we're going to be able to execute against that.
All right, we'll leave it there. Appreciate the time this morning. Mark Hoplamazian, CEO and President at Hyatt. Talk to you soon, Mark. Thanks. All right, welcome back to Yahoo Finance Live on this Tuesday morning. We've talked about it here on the program, written about it on Yahoo Finance. 2020 and 2021 been a huge year for the golf business and professional golf, wrapping up its regular season last week. Playoffs beginning this week at Liberty National. And joining us now to talk about everything happening in the world of golf is the top-rated golfer in the world, Jon Rahm, joining us from Liberty National in Jersey City. Jon, appreciate you taking some time to talk with us this morning. I want to start out on tour. Bitcoin, people talking about it. What are you guys chatting about? You guys are out there killing some time. Everyone's got some extra cash. What's the financial world looking like to you guys?
It is something you hear. I know one player on the PGA Tour who invested with some friends, some friends of his, and they do have a warehouse with over 2,000 computers mining Bitcoin. And he was telling me how much of a gold mine that was going to be. I'm not gonna lie. I don't think I actually know. I know I'm not in any cryptocurrency currently. I know I probably might have missed a big opportunity in there, but at the same time, I'm blessed to do what I do. Luckily, we have the opportunity to play for a lot of money, and as I'm still young, I'm gonna focus on that, and then, well, maybe in the future, when I've saved up enough, I might start thinking about investing in it, but. It is something some people talk about. The cryptocurrency, it's something it's a conversation that goes on.
Well, don't worry, Jon. You got a lot of playing in front of you, and there'll be a lot of people telling you that this is the next big thing many times over the years. So, crypto one thing, it'll be something else in the future. I'm curious, does this feel like one long season to you going from the restart last year? Because as a fan following towards 6 majors just in this season, it has kind of felt like a nonstop grind for you guys. Does it seem that way to you?
Well, it is a longer season. So yeah, you see the added points and everything to a little bit more than usual. People have had more chances, and since there's been so many big events, you kind of see the different streaks. People that played good earlier, play good later, but they still stayed up there in the rankings, right? But I think for the people having playing good golf, it's going to be a better year every year because you have more big tournaments, more opportunities, more to play for, right? So it's something that's unique. The other day I was just thinking, man, I just realized how far away the next major is, which is Augusta in April, right? Because I kind of gotten used to playing one every 1 or 2 months. It's been nice to have that little bit of little break going on between majors, and now we're not going to be able to see another one till April. So I'm going to miss having a year like this with this many majors counting.
Yeah, and Jon, I wonder about peaking, for you guys, how you think about it. We just had the Olympics, right? And swimmers and runners, they spend 4 years and they just get ready for this one event. But you guys, you have big events 4 months in a row in the spring. Ryder Cup's coming up next month. How do you think about peaking, or do you just say, well, I'm playing good golf now, I'll just, I'll just focus up and try to ride that wave?
I mean, I'm not going to speak for other players, but in my case, when I'm deciding what to do with the schedule, obviously we look at the 4 majors first, right? You have the 4 majors in the FedEx Cup. Those are the highlights of the year. You got to peak in each one of those. And it's a little different because leading up to Augusta, you have time. You might have a time off, and then you have 3 months of competition before Augusta. And then basically you have a major every month, right? So you have to be able to peak in those events. And I think more of it is training accordingly, and then after each one being able to get enough rest to get ready for the next one. And that's kind of how I think about it, right? Try to tailor the strength and conditioning to that, and what tournaments you play and don't play in order to be ready for each one of those. That's kind of kind of how it goes, at least in my mind. Now, if you're playing good golf and you feel like you can ride it a little bit longer, I know people do that and maybe play more events because they feel like they're playing good and they like to keep going instead of going home. But in my case, I rarely change my schedule to add more tournaments. If anything, I'm taking them off and playing maybe a different time of year.
John, I last talked to you in 2019, I believe just before you got married, and you were playing great then. Mm-hmm. But since then, I would say you have hit a next gear. You've had top 10 finishes in all 4 majors this year. You won your first major this year. What do you attribute you hitting that next level? How have you done it?
Well, it's a learning curve once you become a pro, right? Even though when I turned pro, I started playing really good golf right away. There was a lot of maturing and growing up to do in that sense, mainly on the golf course more than off the golf course, but still a lot of learning in general, right? I mean, you go from college where basically we're in the financial channel right now where you're basically broke as hell, at least in my case, and then turn pro and start playing really good golf and signing these contracts. There's a lot of getting used to, right? Dynamics change when it comes to families and things change and things change within yourself, right? So there's a lot of getting used to that. And then getting married was a big milestone for me that, that really helped me in that sense, and having stability at home, and then becoming a father has been the cherry on top, right? I think that's what put a lot of things together. I've had a great life off the golf course. I can't complain, but this has taken it to another level, right? And I'm one of those players who I'm not happy because I'm playing good golf. I play good golf because I'm happy, and it correlates, right? The better my personal life is and the better my home life is, the better I play golf. And most of my mental work, believe it or not, comes to, it's work that I do off the golf course, trying to be a better friend, a better son, a better father, and a better husband. And so far I've done a pretty good job. And that's what I keep doing. And I think that's what I attribute that next level, right? It's been incredible. That experience of becoming a father has been amazing. I can say after seeing what a woman goes through, those months of pregnancy and delivery, I got a whole new appreciation for my wife. And that definitely changed a lot of things, right? I've told her even before in person, what she gave us, which is going through that and delivering our son, it's something I could never repay. There's nothing I can do to get even close to something like that. So I think that's what made me, just play better golf. Feel like, again, not that golf takes a second page, but there's more important things in life, right? And it makes it easier to channel all my energy to practice. And then, I get home and I'm dad, it's almost easier to get a break from it. And it's been really nice.
Yeah, John, how is, being a first-time dad, how has that changed how you approach preparing for tournaments? And how has it just changed your outlook on the game?
It doesn't change the way I play. It doesn't change the way I think on the golf course. It just helps me get over things quicker. And especially when I'm done, like whether I have a good or bad day, 10, 15 minutes after, it's gone. Especially if Kelly and my son are there on the golf course. As soon as I see them, it's out of my mind. It's whatever. I might go to the range trying to fix some things if I play bad, but it won't get, my ego won't get too high if I play good, and it won't be too low either if I play bad, right? It's just, it's almost like once I hold my son or I see Kelly and I hug her and give her a kiss, it's a before and after, right? Once that happens, golf is over. I'm a normal person, I'm a husband, I'm a dad, I have those duties. Right before that, I'm still the golfer, right? So I think that's the transition to off golf, John, let's say it that way, just being not an athlete, just a family man, is what's helped me the most with. It's a quick transition, and it's a very nice feeling, to be honest, especially every time I see the little guy, even at the US Open, right? When I held him after making that putt on 18, it's just, for a second, I forgot where I'm at. I forgot what I was doing. I forgot what had happened. I forgot what I had coming, right? So it was, that's the blessing that they give you.
All right. Appreciate the time. Number 1 ranked golfer in the world, 5th in the Comcast Business Tour Top 10 heading into the playoffs. Jon Rahm, appreciate the time. I'll tell you, have fun at the Ryder Cup. I can't wish you luck. I'll tell you to have fun, and we'll see. We'll see how things shake out. John,
I know what you all mean by that. It's okay. Thank you.
That's all right.
Welcome back to Yahoo Finance Live. I'm Jared Blikre. Well, they have them in China. What about the U.S.? Are you prepared for a future with a central bank digital currency? To help answer this question, we're going to bring in Emily Parker, CoinDesk Global Macro Editor and CoinDesk TV anchor. Thank you for coming back here. And let's start out with this. How close are we? We hear Chairman Powell, we hear Treasury Secretary Yellen talking about this, a little bit of jawboning there, but what's a realistic timetable?
There is no realistic timetable. We're actually not that close at all. The US is still in the research phase, so they haven't actually decided if or when they will issue a digital dollar. So on the one hand, some caution is warranted. You want to get this right. But on the other hand, you have other countries racing ahead, namely China. At present, you have 81 countries exploring the launch of a digital currency. The US is still very much in the research phase, so they have not committed to doing this.
Emily, I mean, when you talk about the potential timeline here, of course, a lot of people looking to the Olympics next year is the big unveil, if you will, for China's central bank digital currency, at least on a global level. How much of that you think determines the timeline with which the U.S. moves?
It seems that the U.S. has made very clear that they don't want China to dictate the timeline of the issuance of a digital dollar. And to a certain degree, that's merited because the US wants to get a digital dollar right if it's going to do it at all. It wants to make sure that it has privacy protections, for example. So I don't get the sense that the US is particularly concerned about China's speed. They've actually said that they want to make sure that they do it correctly, but it's time is ticking. And I think the issue is that there are two potential models for central bank digital currency. One is based on government surveillance, in which the government can basically see every transaction. The other has privacy protections embedded in its design. And I think the US has a choice to shape the future of digital money, and hopefully it will choose to go the privacy route.
Before we go, we were talking in the break here about the infrastructure bill, which has a cryptocurrency portion, has to do with tax reporting, kind of onerous, and now it's in the House. Where could this proceed, and what's the worst case scenario here, and what's the best?
So if you ask crypto advocates, the worst case scenario is that the bill continues in its current form, which contains language that many crypto advocates believe is very unfriendly to the cryptocurrency industry, specifically language that makes it difficult for certain actors like miners or validators or software developers to comply with US tax regulations. That's where we are now. It is proceeding to the House, but we don't know yet if the language is going to be changed.
Demand for coal is increasing in the U.S. again, brought on in part by the rising cost of natural gas. The EIA estimates coal consumption and electricity generation will increase nearly 20% this year. But a new report out from S&P Global Market Intelligence says an aggressive push to mandate renewable resources could strand roughly $68 billion in coal assets. Let's bring in Steve Piper, the author behind that report. He is S&P Global Market Intelligence Energy Research Director. Steve, it's great to talk to you today. Let's talk about what we're seeing right now, because I looked at that government data. It is a little surprising when you think, well, I thought we were talking about moving away from coal. That number is moving up again. What's behind that push? And is there a concern that coming out of the pandemic, as we see the economy rebound, there is a reliance on coal yet again?
Yes, thank you for having me on today. Certainly, coal is doing a little bit better this year compared to 2020, which was a historically bad year. The interesting thing is, as you indicated, the price of natural gas is much, much higher as a competitive fuel to coal generation. So we're seeing coal recover this year. And what it really tells us is that the reduction in carbon emissions that we've enjoyed over the last several years due to natural gas being more competitive than coal generation, that era may be coming to an end. And that if we expect to see additional emissions reductions from the coal sector, renewable energy is going to need to continue its rapid expansion.
Now, as I understand it, to retrofit one of these coal plants, and I think your report covers about 100 of them, that they generate 130 gigawatts. What happens if these plants are in fact stranded? Are we going to see rolling blackouts? I mean, are these located in parts of the country where the electricity is critical to the grid?
Absolutely. The coal fleet, will remain critical. The prospect of the coal plants becoming uneconomic is a matter of concern. If they become stranded assets, that generally means that to the extent they shut down, that they're going to be replaced by renewables generation and new technologies that probably will maintain to a certain degree reliability on the grid. But the question of what happens to all of those investments in pollution control over the last 5 or 6 years becomes critical, because those investments were undertaken with the expectation that they'd be able to recover those costs.
So what happens if you can't recover the costs?
Well, the investment community starts to back out of those assets. They may shut down, and then rates would have to increase to essentially replace those assets. So it becomes a financial question of how do you sort of recover the costs of pollution control investments over a shorter period than was originally contemplated when those pollution investments were made.
I want to ask you, has this played out in other countries, other regions of the world, some place where we could kind of look to that as a model and say, okay, this seemed to go pretty well over here, or are we simply all progressing on the same timeline here?
The experience in the United States is somewhat unique in that the United States has done more than probably other regions of the world to deregulate power markets, and in many parts of the country expose those investments to competition from newer forms of generation. So the question of stranded investment and stranded cost is fairly unique to this country.
And Steve, we've seen the challenge that comes with this transition, not necessarily in coal, but with oil, for example. If you think about the investments that are being made in renewables, if it's about transportation and EVs down the line, those are investments that we see pay off years from now. And yet in the meantime, you've got the White House, which has made climate the center of their domestic platform, last week calling for an increase in production from OPEC because gas prices have gone up. When you think about having to transition from what we have seen, the demand on fossil fuels, to a more low carbon future, can you talk about the challenge, especially with coal, sort of in the middle here? What does that transition period look like? How bumpy is it? And ultimately, what kind of hit do consumers have to take because of that?
No, it's a great question. It's an issue of concern to policymakers and to the American public. Certainly, the need to decarbonize the electricity system, is being increasingly recognized, and that involves basically replacing our old generation systems, coal and increasingly natural gas, with new clean generation, backed up by storage technologies and other new technologies. Replacing new things with old things costs money, and what our report draws attention to is that making those investors whole on the original investments also costs a bit of money too.
Steve Piper, S&P Global Market Intelligence Energy Research Director. It's great to have you on today. Really appreciate the time.
We want to bring your attention to a new report from the American Council of Trustees and Alumni that finds that rising higher education tuition and student services costs has actually led to a decline in student diversity, and it's having little to no effect on graduation rates. For more on this, we want to bring in our next guest, Michael Polyakov, PhD and president of the American Council of Trustees and Alumni. Dr. Polyakov, great to have you on the program here, and we want to dig into this report, but help our viewers understand and quantify the situation as it relates to the higher tuition costs and some of the effects, the impacts that you all have found, especially on lower diversity.
Julia, thank you. It's a great honor to be with you today. Yes, the spending habits of higher education have gotten us very poor results. On the one hand, they are the driver of higher and higher tuition, which is something that tends to discourage students from completing their college education. And on the other hand, they have very limited impact on completion, on getting that degree that prepares a student for the workforce and for engaged and informed citizenship. Altogether, we are taking a system of higher education that has been called the envy of the world into a situation in which it seems to be engineering its own meltdown. One of the things that we discovered in this report is that it's not so much the cutbacks in state and federal funding as it is the investment in bloated administration and student services programs that keep ratcheting up the price of tuition while not increasing that most important outcome, which is completion of the degree. If there's a single takeaway, I think we have to say that when a school wants to buy the farm, it's got to be cognizant of the fact that there's going to be a mortgage on that farm that's going to be paid largely by students with now a $1.7 trillion burden on their backs in debt. And those colleges and universities need to really ask, are they buying something of value? And what we're finding is their investment in teaching and learning has been, in fact, a lower priority, a lower spending priority than the burgeoning in administration and student services programs.
So let's talk about what's at stake here, because the money quote to me in this report was that a $1,000 increase in tuition and fees causes the racial and ethnic diversity of first-time, full-time freshmen to decline by 4.5%. First of all, how did you arrive at that figure? And then secondly, what is the ultimate impact of that if there are communities who are entirely boxed out from being able to attend these programs because they can't afford it?
Thank you for that question, Brian. The worst possible outcome is for us to be boxing out communities that really need to be in higher education, which has been both the engine of our nation's progress and the real vehicle for advancement into all the promise of American life. And what we find is misplaced investment. That's to say, when, for example, a school, let me take, for example, wants to build a very expensive building, it might have some donation from alumni or other sources, but it is the gift that will keep on taking because its maintenance costs will be almost the same as the construction costs. And those things are going to go into mandatory student fees or tuition. So that for the communities that are struggling, instead of getting the kind of institutional support, the scholarships they need, they're seeing that money going into things that will not help them stay in college and advance.
Mm-hmm. You know, you bring up the point of these kind of bloated administrations and student services, and like sometimes you go see a student union and it's completely empty, and you're not talking about the funds not really going toward the scholarships. Do you think these administrations will wake up and realize, wow, all the funds are going toward us versus the students? And have you noticed any universities actually wake up to this and do something about it? Do you think there will be meaningful change here?
I'm so glad you asked that question, Julia. There are very positive examples that other institutions should follow. Purdue has kept its tuition frozen for 10 years. It has lowered administrative costs under the leadership of President Mitch Daniels. Arizona State University is way below its peers in its expenditure on administration per student. Florida State University is a leader. Christopher Newport, here nearby in Virginia, has shown that all of this can be done. So what the impact of this large regression study is that in the aggregate, our colleges and universities are not doing it right. They need to look towards those positive examples, and their trustees have to be absolutely meticulous and ask those hard questions. It's wonderful to spend money on programs and to have new offices, but they have to ask, what will be the impact of this cost?
Well, Dr. Michael Polyakov, President of the American Council of Trustees and Alumni, thank you so much for your time today. David Zervos, the Chief Market Strategist for Jefferies. David, you had a great note out on Sunday evening that garnered a lot of attention, certainly caught our attention, and it was following some economic data, the University of Michigan's survey of consumers. And in that note, you pointed out that our consumer is far more fragile than many are thinking, which is why the Fed is playing a very dangerous game with its turn toward more hawkish rhetoric. Would love to explore this thesis that you laid out here and then in the note and some of the reaction that you've gotten.
Yeah, it's nice to be here, Julia. First of all, thanks for having me. And yeah, I think that note, it did get a lot of attention, probably because I wrote it on the weekend, and I don't usually write on weekends. But I wanted to kind of start everybody's week off by having them read the opening paragraph from the chief economist that puts together that University of Michigan survey, which probably nobody's ever heard of. His name is Richard Curtin. But he wrote a very sobering paragraph, and when you read it, and I tend not to get caught up in any one individual data piece, but when someone tells me there's a 50-year time series of data, the University of Michigan Survey of Consumer Sentiment, which has been around for 50 years, and we just had the 6th worst print in history, and it's worse than it was at any time during the pandemic, I kind of go, well, that's pretty serious. Let me dig a little deeper. And reading Richard's note, I was just very struck by the tone that he had, and I think he made a very important point, which is that the emotional scarring, and he used the word emotional, and I like that a lot. The emotional scarring that our consumer has had through this entire pandemic process has been a lot more extreme than many people are thinking, and I think that's it's nice to put these numbers up about how GDP has recovered and how we've gotten a lot of the jobs back. But, people's confidence on their employment outlook and their income outlook fell. It fell last month in the survey. It fell by not as much as the sentiment toward inflation caused the drop, but the fact that it fell with 10 million job openings and jolts tells you that people's confidence is not as strong as many would hope. And certainly, I think the Fed would hope.
Right. And as you point out, it runs counter to a bunch of the narratives out there. I would like to dig in on this a bit more. And what do you think is weighing on that consumer sentiment? I know you brought up a few ideas here, but, is it inflation or, is it the Delta variant? As you kind of dig into it, what do you think it is? What's at the root of it here?
I mean, I think the inflation story has definitely got people focused, and you hear it in, everyday discussions. You hear it in the markets, you hear it, with your family around a dinner table, and you see it in the survey data. We're up at pretty high numbers for the short-term inflation expectations, although, Julia, they did drop back last month. So the 1 year ahead inflation expectations actually fell, even though long-term went up toward 3%. But here's the funny thing is inflation expectations, the long-term numbers, were actually higher back in 2011 than they were today. They were, I think, 3.2 or 3.3 was the peak, and now we're at 3%. And 3% isn't that crazy for long-term inflation expectations. They usually have been well above the 2 number on a regular basis. So I don't think you can really say that it's inflation expectations. What you could say, it's the speed with which the inflation numbers have moved, the velocity. So that's probably more of a culprit. We had a 0.9, a 0.7, and another 0.9 on the core CPI. And now we just got a 0.3, which is a great relief, especially to the transitory folks like myself. But, to see used car prices going up 10% in a month, and then 7% in a month, and another 6 or 7%. I mean, these are huge increases in things that people, on the ground are seeing. It's not, it's not like, cruises on yachts have gone up or prices of high-end goods, although they have gone up, but it's real everyday things. And even things that affect, say the bottom 80% of the income distribution, not the top 20% of the income distribution. So I think there's something to that. I also think that people are just not as confident that this job market is as robust as the data might say. And let's also go back to one other thing, Julie. We are still missing 5.8 million jobs from where we were in February 2020. Yes, GDP is back to its now highest level in history. We surpassed the Q4 2019 numbers in the last Q2 report, barely. So we're basically flat in GDP for 6 quarters, but we're doing the same GDP, making the same amount of stuff, producing the same amount of stuff with 5.8 million less people. Now, if I were a worker and I saw that this economy could produce the same amount of stuff that it produced in Q4 of 2019 with 5.8 million less jobs, 5.8 million less people employed, I'd actually be a little bit worried about my job, because that tells me that productivity has surged and that my job may not be around as long as I really want it to be around. So I think there's a lot of anxiety on the job front. Even though it's an amazing time to get a job, the duration of that amazing time may be catching people a little bit, maybe causing a few sleepless nights for some.
Hey, David, it's Brian Chung here. Fascinating conversation here. Now, obviously, as we head into next week's Jackson Hole Symposium, where the Fed will be offering a little bit more commentary, what do you think is going to be the big story? I mean, your fixation on the labor market is their fixation as well, especially under the new framework. And we know that the Jackson Hole speeches and commentary tend to be fairly academic in nature. Do you expect that something like inflation expectations would be a big focal point of Jay Powell's speech? What do you expect to see next Thursday and Friday?
I don't expect a lot of fireworks. I think this is not the time nor the place to bring up we're about to start tapering. I think they do want to see another employment report before the next meeting for sure. So I think that's not the storyline. Inflation expectations, look, inflation's kind of going in the right direction for them after the last CPI report. So I don't think there's a lot to get, souped up about in that one. What I do think is that the title of Jackson Hole is about income inequality and what central banks can do to sort of deal with that, and what that means for the overall performance of the economy. So I would expect Jay to be addressing more of this income inequality issue, and maybe have even some touches on some of the environmental concerns that have come up in a few of the speeches on the ESG stuff, which is much further ahead in Europe and Japan than it is with us. But nevertheless, I think it's going to be more about those things. But in particular, I think it's going to be about the inequality issues, and probably doing a lot of repair work to say that the Fed did not cause inequality. That's one, because they don't want to be seen as having done that. And there's a lot of folks out there that do believe that many of these policies did contribute to inequality. So there's some repair work. And then some ideas on how the Fed is thinking about tweaking its toolkit in the future to help deal with some of the inequality issues, whether that's the next set of programs that come in a downturn that target more of the inequality issue, rather than trying to be blanket programs for the entire corporate bond market or the entire muni market or the entire commercial paper market. I think that's going to be an interesting part of the discussion. Whether anything significant comes out, I'm skeptical. I actually am more likely thinking this is a dud than anything else, but we'll see.
Well, we'll certainly be watching. David Zervos, Chief Market Strategist at Jefferies. Always great to have you on the program. Thank you so much for your time.